evening, everyone. It gives me immense opportunity to have this wonderful panelist who comes with wealth of knowledge and information. But just quickly before I go to these experts, just to set the context, we know climate change is one of the biggest threat to mankind, and it impacts disproportionately the most vulnerable uh, countries in the world, including India. And we are seeing and that in this climate world, the things are changing. So in this new paradigm, we are seeing the world where we are increasingly looking at 100% electrification, and that electrification coming from 100% renewable energy. Also, we are seeing demand acting as more responsive to the changes rather than the other way around. Further, there's no concept now like a base load capacity any longer, so there is a shift happening there. We are increasingly seeing consumers becoming prosumers, so they are both the producers as well as the consumers of electricity. And then we are also looking at storage coming in different shapes and forms. So increasingly the adoption of storage is happening and at different scales. In this new energy sector, there is a huge requirement of investments and as well. And this investments also has to come. The shift of investment flow is also happening. Investors who are behind the curve or are looking at fossil fuels, we are seeing increasingly, the issue of stranded asset is becoming increasingly common, and they are also one of those which are looking at increasing the environmental impact. But on the other hand, where investors have shifted, they are looking at much better returns with energy transition technologies, which are much more cleaner, as well as contributing positively to the environmental impact. We have seen that there is good level of progress happening in the country with more renewable energy adoption and the whole ecosystem being developed. But that would need huge investment. So if India has to meet 2030 goal, we need both investments from domestic as well as international sources, both from public and the private capital. We really need to tap into the ESG pool as well as green markets, sustainability linked bonds, apart from the conventional debt market that has been the norm so far. Also, the public capital, the role MDBs have to play along with philanthropic capital to, de-risk or provide some of the concessional capital, and the guarantees will play a big role. So, with this background, I would now call upon Mr. Chintan. Starting with, we have seen power sector companies in India are transforming their business models, and they've shifted from providing or being plain vanilla from plain vanilla developers to, energy service providers. So how do you see this phenomenon changing, and how does this primarily impact the investor sentiment?
Uh, Thank you. I think this is more of a logical curve that the industry is going to follow. Because when it started off years back in tapping RE projects or RE investments was essentially on a feed-in tariff basis, a preferential tariff. Then we migrated to bidding. That's what has happened, and that's the mainstay today. Going forward, you can't have 500 gigawatt of entire execution done purely on a bidding framework. That's not possible unless you start getting into a role of a utility. So essentially, what is happening is a new going forward. Most of the IPPs or the RE investors would be essentially mimicking like a utility. And a utility, when you have a distribution company, it provides services and it builds everything. And that's what exactly is happening today. Bulk of the investors are now getting into the CNI segment. That's the start of it, where essentially mimicking like a utility. You do all the settlement done and all. Going forward, this is going to take one much further when the hydrogen economy starts, because now you're talking about energy as a portfolio beyond electricity, And as you know, hydrogen is like a Swiss knife, because you are able to, if you, I'll just give you a small example, is if 100 units is the energy quantum of India as a consumption, it's 70 units of electricity. That means 83 units. It's still primary energy, which is essentially coal, oil, gas, wood, hydro and all. And that's a level of electrification that has happened today in India. Just to give a perspective, it is 26% in US. We are targeting to go to 38% electrification of the entire energy basket by 2047. Still, a bulk of steel is going to be non-electricity. How do you do a transition for them is the key part to it. That's exactly what green hydrogen addresses. The moment you get into hydrogen, which is green hydrogen, you start replacing oil and gas in real sense, where you can't just replace. For example, if you have a blast furnace in steel, there's no way you can replace a blast furnace because it requires coking coal. And that's the process. You cannot replace it with electricity there. So you require something like a green producer gas, which can replace coking coal and go for energy transition on the steel side. Similarly, you have major industries over there. So this is an evolution that is happening, and this will continue to happen. And essentially, large players which are into the RE space will start acting as a utility player. They may not actually lay down the distribution line. Maybe in the future, when we already have started in India, is a parallel distribution license scenario, where you can have a parallel distribution license. You don't have to actually own that distribution network. And this is the way forward. You'll have a fair amount of parallel distribution licensing happening, and where maybe bulk of the RE generators, along with their FDRE type of construct, start offering electricity solutions which are green in nature to the users at large. So that the user can concentrate on their core business, which is the manufacturing of whatever the thing may be, while these people, the RE generators, can concentrate on providing a full package solutions. And this is even more relevant now because of the cross-border tax that is going to be imposed in Europe. When you're going to export from India, you need to also produce green certificates for emissions, which will essentially help you to reduce your taxation when you're exporting to Europe. So this is something that is evolving and is continues to evolve.
Great. Aalok, coming to you, we are also seeing, I mean, while the business models have changed, from plain vanilla to energy as service models, but also there is a lot of consolidation happening in the renewable energy space, where through mergers and acquisitions, a lot of big players have acquired the smaller players. How do you see this impacting both the financial and the strategic investors, and how do you see this this recycling of capital happening through M&A space?
Sure. So I think I'll just break this into from the capital perspective into two parts. You have both international investors and the local equity which is available. I think what's happened over time is there was a lot of money which was invested from 2014-15 onwards. Now that capital has reached a point where they are seeing exits because they need to return capital back to their LPs. So a lot of portfolios have churned over this while, and that's the reason why we are seeing so much of consolidation where sponsor-owned platforms have exited to certain strategics. And what we are seeing is, from a strategic perspective, it's largely Asian strategics, both Indian and maybe from the Southeast Asia region, who are consolidators and acquirers. And European strategics are the ones who are deconsolidating debt from their balance sheets, in their parent balance sheets, so they are reducing their stakes, but at the same time owning 100% of the DevCo. So I think that's been the current strategy amongst the strategic universe that we are seeing. And I think that will probably continue. We'll see more and more of Asian strategics. We are also seeing Japanese strategics now look at the market very closely. So, and they are focused more on the project level investments as their test case to enter the Indian market. And with success in the project level investments, then they'll look to flip into the topco level investments. So I think that's a new trend which we'll see over the next few years, where we'll see more and more of Japanese capital coming into the country as well. But I think largely what we are seeing from a capital and consolidation perspective is we need a lot of growth capital to come in. With the Fed announcement of 50 basis points reduction, over the last few years, we are seeing the larger infra funds, sovereign funds, pension funds focus more on the Western markets because they were getting better risk-adjusted equity returns. That probably should change going forward. A lot of large infra funds have focused India pools of capital now available. So they are actually investing more and more, and we've seen that a few recent announcements or investments made by the larger global infra funds. So they continue to invest, but going forward, expectation is that some of the pension funds who were on the sidelines, who've not invested in the country yet, some of the other Canadians will probably come back and look at investing more in equities here as well. And sorry, and just to add to it, given the capital markets where they are, I think that's the other avenue that we are seeing where IPPs are tapping that to raise more equity capital in the current market scenario.
Right. I think that was something which we were just discussing before we moved on to the stage, that India has a lot of domestic capital. If these institutional investors start putting their money in the sector, I don't think India needs international capital, but that's something which we have to really ensure that convergence happens. But so far they have shown limited kind of interest in investing into these so-called, I mean, these are infrastructure funds, but at the same time, their exposure has still been limited. Aalok, also I just wanted to check, we are seeing the surge in the stock market and a lot of companies announcing their IPOs as well. Do you think this is this momentum is also building in the energy companies and a lot of capital will be raised through the IPO route?
So I think if you look at there are a few companies which are already in discussions to file DRHPs for IPOs. Our view is a lot of CNI players will find the IPO route more attractive because from a market's perspective or investors' point of view, CNI offers growth from a corporate and industrial use perspective. Especially when you have customers who are data centers and large auto component manufacturing companies or even IT companies. That's like a play for the investors who can't directly invest into that. So that's the India story playing out, but through the clean energy route. So I think some of the CNI focused players will be tapping the capital markets, and there would be, let's say, good demand for those kind of companies, from an IPO point of view, because largely Indian equity markets have been very growth-focused investor community, right? They prefer growth over dividends. So the CNI platforms offer that growth because there's so much growth happening from the end customer perspective for them.
Okay, thanks, Aalok. Pratyush, coming to you. Aalok did mention about this recent US cuts of 50 basis points. And that is kind of, further, there is a growing level of interest in the debt market, especially the international capital. What role do you see sustainable finance instruments such as green bonds playing in the capital structure of clean energy companies in India, especially considering that so far most of the funding has been coming from the domestic market?
Yeah, thanks Vibhuti, and thanks Economic Times for inviting me to this event. Capital is the fuel which this industry needs. I think I'm glad that at least at the end we have a session on capital. If we look at the climate challenge we are facing, and I'm quoting Bloomberg New Energy Finance, to reach to net zero, India needs about 3 terawatt of renewable energy capacity by 2050 or 2070, whatever you count. And that requires about $12 trillion of capital. That's a lot of capital. And that means that we need to find a very large and broad-based investor type. And we need our investment opportunities to be competitive in the market. So coming to your question, how much would specialized, sustainable finance-focused instruments help us achieve this goal? The answer is only one way: yes. We need innovation on all kind of work we're doing in the industry. We need innovation on the technical side. We need innovation on project deployment. We need an innovation on market structure. But coming to capital, you're right, over the last few years, especially after COVID, when the international interest rates started going up, the attraction towards international capital in the industry went down, purely for the reasons of cost. International capital was not competitive compared to the capital available in the country. But even now, the renewable energy industry especially is largely dependent on term loans from banks, as Chintan was sharing also a while back. And that remains to be the mainstay because the industry has still not established itself as being stable enough for the bond investors to be attracted towards it. Yes, we can do a lot of work to improve the attractiveness for bond markets. Green bonds do help because they provide some sort of structuring in the paper which attracts a type of capital. But if you personally ask me, I don't think there is any greenium available. Everyone thinks that green bonds will trade at a premium, there'll be a yield reduction, but the global understanding is that the yield reduction, if you get a 5 basis point yield reduction, you're doing great. So ultimately, the basic investment opportunity should be improvised to a level that it becomes attractive for all kind of investors. These investors are both debt and equity investors. I can talk at length on both sides, but especially on the debt side, we need to broad base the type of investment available. And for that, a lot of action needs to be done on improving the quality of debt paper which is available and broad basing the type of investors who invest in this paper.
Right. Pratyush has just highlighted one of the ESG instruments, like on the green bonds. Mr. Harish, coming to you, despite SEBI's effort to evolve the regulatory framework for ESG instruments, we have seen very limited success so far. We just have had few ESG themed bonds currently operating. So can you shed some light on the reasons behind, why there has been such a lag and the kind of barriers that this market is facing, and how we can improvise in terms of, more green bonds, more green equity or transition bonds being created through facilitating investing through exchanges in India?
Right. Good afternoon, everybody, and thank you for the invitation. ESG is a fairly recent concept in India for the last 5-7 years. We've heard the word ESG more and more, but I think like every new concept, it requires embedding. It starts with talking about it. Next, what I call the tick box approach, where you just follow the guidelines and then you internalize it. We have probably reached close to the tick box level in most corporates. Some of them are obviously leaders ahead of them. India, in terms of regulation, has been quite active and probably forward-looking. The BRSR framework has come in and is giving us a lot of data. And if you see, the first set of disclosures came only last year. So the ESG equity funds, which today there are probably 9 funds only with hardly 10,000 crores of AUM. They came much earlier and they didn't have the data to make the evaluation. The ratings on ESG were not there. So they made their own assessments and by and large, the data shows they haven't performed well. Ultimately, I think we heard there is not much greenium. There's probably not much depth in the equity market in India because it's mostly domestic capital. I think the market for equity, debt, etc., there are 2 parts. Is there a premium or a greenium for debt or equity that has the ESG rating? Maybe something which we can debate. Presently, we see very little of that. But what we will see going forward is the deepening of the capital available for these pools. So while you may not get a greenium, you will get capital. And I'll give you a simple example. Sriram transport finance, which is in the financing space, they raised a social bond. And I was asking them, what did you get? Did you get any advantage? He said, we did not get even 1 bit less than what we would have otherwise got. But what we got is the ability to raise, I think they raised 16,000 crores in the international market because of calling it a social bond and following whatever the social requirements are. So that pool of capital, whether it is ESG equity or debt, is increasing. And if you are not in that market, you won't get that capital. So I think that is the change we will see going forward in India as well as outside. In India, we need to educate people what is the value of ESG, and I think we are much ahead regulatorily, but in terms of public awareness of what is ESG, we are quite behind. It took probably 10 years for India to pick up on governance as a concept and attach a premium to governance. It will probably take some more time for Indian ESG to take that.
And you also talked about the BRSR, but I think what even some of the developers or investors are also struggling is when they have to kind of, there are different requirements from different players or different markets, I would say. Like, how do we align the BRSR with TCFD kind of framework so that we don't have to follow different frameworks and meet their requirements? So there's a lot of discussion on interoperability of these frameworks. So where do you see India stands in terms of, adopting those well-established global framework?
Well, I mean, I will give you a comparator for this. I think at some point we had accounting standards which were different for each country. And I remember in the earlier days, the Infosys used to publish their results in Indian GAAP, Korean GAAP, Japanese GAAP, US GAAP, UK GAAP, and so on. And we are somewhere there in terms of regulations for BRSR. And everybody is trying to say this, our standard is the best. So I think the forward-looking people who are looking to raise capital domestically, internationally, will have to perforce do what Infosys did. And just like IFRS came over a period of time, I think we will see capital markets aligning. It's an unfortunate way of doing. Hopefully we learn from the gap experience to do this faster, but it's unfortunately we are there. I mean, the BRSR does take a lot of things from different things, but it has its own issues. Every country, every regulator wants to say mine is the best. So we are in that stage.
I think regulation plays a very, very key role. So we have also seen, regulatory developments in green and transition taxonomy, along with sectoral transition roadmaps. So we have seen countries like Japan who have recently issued sovereign transition bond, which has been facilitated by transition taxonomy and sectoral pathways. Mr. Chintan, I would like to draw your expertise on where do you think India should do you think that India should follow a similar path in terms of having a green and transition taxonomy, which also coupled with sectoral transition roadmaps? And where do we stand now, and what kind of pathway that India needs to adopt?
Green taxonomy is definitely important, and I think this is also seconded by Nirmala Sitharaman in her last budget, where they said the government is working on a green taxonomy document. As far as renewables is concerned, limited renewables right now, giving a target of 500 gigawatt by 2030. I'm not even talking about 2047. The total, and with about 5 million tons of hydrogen, green hydrogen, the total debt capital needed is close to 28 lakhs to 32 lakhs crores. That's a reality. That's a real number. And this money definitely cannot come from term lending. There's no way. There are only 2 to 3 lenders, large lenders, which are focused only on infra and renewables, which is PFC, RAC, Radar, maybe non-NAPIC. But they also have lots of other obligations, like they also finance ports, roads, bridges. So you have sort of segmentation over there. So my personal intake thing is, roughly about The term lending can be go up to 10 to 12 lakh crores, nothing beyond that. You don't have very good money. And it's also important to recycle the debt. Because what happens in a debt recyclation, maybe you have the underwriting agency, the term lenders, and finally to the bond market or to the physical money markets. That's what we call. Unfortunately, in India, the bond market mimics the corporate bond market. You have a sweet spot of 3 to 5 years where the bonds get subscribed. So if you have an asset, say renewable asset, which has got an economic life of 25 years, it's a stable asset. It's got a nice PPA, all security is done. You've got double A rating. Try to raise a bond of 15 years, you will not get subscribed. Because that's not the market, is not created yet. Our bond market in India is not deep enough and not long enough. When he talked about, my colleague over here talked about the greenium, I think before the greenium, you need to essentially ensure you can actually create a bond market which has got a tenure of 10 to 15 years, which is asset backed. That is the key part of it. That's what renewables want. So unless you create a bond market which is in the range of something like 14 to 15 lakh crores, this is going to be a problem on the debt side. And you have money available in the market. It's not that it's not there. There are lots of institutional capital available, be it the insurance companies, the pension companies, the mutual funds. I think it's what is needed is a right platform so that they can offload their money and subscribe to the bonds that can be created. AIF category 2 framework is one of them. One can be using that. This is what is needed, and I think that's where the green taxonomy comes into picture. If a particular institutional investor wants to put money in a particular bond market, the taxonomy holds the key. Now, SEBI has already brought out a paper on this, where they're talking categorizing green bonds into subset of green bonds. They're talking yellow bond. That means if you're going to put money into solar assets, it will be triggered as yellow. Or sustainable water management is blue bond. These are terminologies not just in India, it's across the globe. Because essentially this bond market can be subscribed by anybody in the world. The whole idea is that, hey, we have a project here, it's got a stable returns, why can't you put a long-term money over there? And that's exactly what the insurance companies and the pension companies want. They would like to put money for an 18-year tenure, a 20-year tenure, which is stable enough. So it's it's an ideal situation. And what I'm trying to tell you over here is already happening in US or in Europe. It's just that we need to also emulate a similar thing. And to start with, yes, taxonomy is needed. Regulations backed for that is also needed. Otherwise, the money will never flow. That's what it is.
I think definitely we need some long-term patient capital as well. Aalok, Mr. Chintan also highlighted recycling of debt. So we are seeing that despite presence of high-quality assets, the infrastructure investment trust market has not gained substantial traction in the renewable energy sector. What are the challenges that has led to not so much capital being raised through InvITs? And how can these challenges be addressed in the Indian context?
Sure, I think definitely roads and transmission assets have seen more takers for InvITs, and they're quite prevalent. On the renewable side of things, I think what's happened is there have been 2 instances of InvITs which are currently there, and we are aware of a few more who are attempting InvIT. So I think that will soon change, but still I think the quantum will be very different from compared to roads. I think one is, of course, you need AAA rated offtake to be able to put those assets into InvITs, and also the debt to equity of 49% is required. I think what investors have generally liked is the fact from roads point of view is that you have inflation built in. Here you will have fixed tariff over the life of these assets. And the other key question we've heard from investors from InvITs for renewables is ability to add more projects and drop them into this at the same equity levels or equity returns that they are targeting. So I think some of those factors have caused InvITs to not really take off in renewables the way it's actually happened in roads. But I think, as Chintan was also saying, I think if you're targeting capital which is looking for stable return over a longer period of time, then definitely the bond market seems to be something which renewables does offer, to those kind of investors versus just going after the InvIT structure for these projects. And look, I think the equity markets IPO is also the other alternative compared to tapping the InvIT structure to raise equity. So I think the IPOs will currently, in the current environment, will definitely be an alternative that some of the other companies will be exploring.
So it looks like, again, the bond markets and the IPOs are much more attractive. Mr. Harish, we did discuss about the ESG framework, but from the corporate lens, they are also kind of evolving and are responding to changes in the regulations and the investment landscape. In the power utility sector, many companies have in fact committed to more renewable energy adoption as well as net zero commitment. How do you view these commitments within the context of broader corporate strategies, and also whether Indian companies are effectively kind of integrating ESG into their corporate strategies?
Yeah, I think a lot of it comes from within, but a lot of it comes from investors. And I'll give you the example of Tata Power or the Tata Group in general. I think they woke up one day when Norges dumped Tata Power wholesale. 100% of their holding was dumped in one day, and the group, I think this must have been 2014, 2015, woke up and said, "What's happening?" That's when they understood ESG and started thinking of what do we do, and announced over a period of time a plan to move towards renewable. This is for Tata Power. And I think the pressure from regulators, the pressure from investors and from public is pushing this as much as the economics of doing it. Ultimately, all these pressures will also work if the economics are there, and people have seen the economics being there. In terms of internalizing, I look at ESG very simply. I mean, there is the environment, society, governance. I look at it as efficiency. Anything you do to make yourself more efficient is good for the environment. So, just think of ESG as, because otherwise when you say environment, I think the first thing which comes is there an added cost? Is there a burden to me? But if you say efficiency, it's good. Social, take care of your people, take care of your surroundings, it's good. Governance isn't something which everybody has to do. So I think internalizing is happening, but like I said, it's early days. Some will be ahead of the curve, most will follow.
Pratyush, as Mr. Harish was just mentioning, we are seeing a lot of internalization or, the corporate decarbonization plan. While this might have been led by investors or the boardroom, the board members who are kind of pushing these corporates, but we are seeing a big change in the market mechanism where corporate PPAs are becoming much more, kind of evolved over the years and are, so I would say rather than people looking at purely from buying power from discoms, so they are looking at corporate PPAs, which is becoming much more lucrative. How do you see this market developing, especially in light of growing, number of corporate decarbonization commitments in India? And any reflection on how the returns vary from these corporate PPAs versus the conventional RE tenders?
Sure. Maybe I'll just expand this question to what is the impact of power market design and the availability of options. So there are two key stakeholders here, and I would set the debt investors aside for a bit. One is the power consumer, and the second one is the equity investor. If we reflect on the overall growth of renewables in the country, it started off with feed-in tariffs, where there was a long-term price certainty provided to the investors so that we can attract investments. And this price was relatively higher than the market price because the technology needed that kind of price push. And then we saw the whole regime of competitive bidding coming into the sector, which helped create a virtuous cycle of making renewables very competitive, which helped both the consumer as well as the investor. Because consumers who were primarily discoms found that renewables are now cheap. Where solar can today beat any other technology hands down on price competitiveness. And for the investors, because they found very long-term contracts which gave them revenue certainty, and technology was anyways relatively okay. That reduced the risk for investors and attracted more capital. But at the same time, the ultimate beneficiary, which are, at least in the larger scale, the corporate or industries, they have now emerged as one of the key stakeholders, as you were highlighting, over the last few years, where at least large corporates have made voluntary targets on getting to 100% renewable or on a staggered basis through very short-term to long-term targets. The second one is the renewable purchase obligations on industries, which at least industries are meeting on a regular basis. We can't say the same about discoms. So that has been a great boost for the deployment of renewables in the country recently. And that was pushed significantly by a regulation 2 years back, where the waiver of interstate transmission charges were also offered to corporate customers, and which was earlier only available for discoms. So we see that now corporates and the end users can influence how the power is being purchased through corporate PPAs. And then they can also attract capital, where capital is funding such projects which are selling power to corporates directly. Of course, we are facing challenges. As Aalok mentioned, getting debt financing for corporate PPAs was challenging, at least 4 or 5 years back. At least mainstream banks did not invest. But that has been resolved to a large extent. Corporate PPAs are funded by banks very easily right now and get almost similar terms and conditions. They're slightly inferior, but similar terms and conditions as the DISCOM or SECI-backed long-term PPAs. How it is going to evolve, and it's already evolving, is that there is more market exposure coming into the revenue side of power projects, renewable power projects. And one of this is taking merchant exposure on the project itself. Because if we want to deploy this kind of capacity and this kind of capital, you need all type of capital available and all type of projects available. And some of the investors are not very happy with the level of returns a fixed price PPA will provide. And they would be happy to take a little bit of more risk. And especially in a country like India, where inflation levels are high, on a real basis, a fixed long-term PPA is actually value reducing. And that is not very, very attractive for public market investors or, say, alternative investors who have higher return requirements. What we have done recently is that we are setting up a 300 megawatt wind solar hybrid project where we will be selling all the power on power markets. And then that project has been structured in a manner that there is some upside possibility. We've got into a long-term contract with a power trader who is providing an insurance with a base price. So there's a floor price protection. But if the prices in the market are higher than the floor price, both parties share the exploits. Right? So with this, the investor, which is our investor Macquarie, they are able to get some linkage to the power markets if there's a price increase in the power market. If you see right now, the average prices are around 5 to 6 rupees, while the long-term PPAs are trading between 2.5 to 4 rupees. So there is a premium, at least for a sustained period. The key challenge was debt. How do you get debt when there is exposure? But that's where I think the voluntary programs of large corporates, especially international companies, they are supporting through the International Renewable Energy Certificates program, where when they find that it is not possible to meet their 100% renewables target through actual purchase of green power, they're buying certificates. So what one can do is that get into contracts with such consumers on a long-term basis, which provides a stable flow of cash flow over and above what you sell on the power markets. So a lot of innovation is happening. I'm very glad to share, I've worked across markets in Asia. I mean, let aside a few developed markets, India has the most dynamic market in the region. And that attracts a lot of investors to come into India and invest into our projects. So this is one field where we are doing great, and a lot of more exciting and innovative concepts are going to come.
Great, good to see. I mean, till about some time back, there were no projects which could be financed if they were purely merchant based. So you really had to tie up long-term PPAs to have investors invest in those projects. But good to see that change happening. Also, when you were talking about innovation, do you think carbon markets, which are again coming up in India in a big way, will change the dynamics?
Yeah, I think that's very important. And maybe I'll just add on debt. We got 75% debt from private sector large banks. So debt is also backing such projects. On carbon markets, I think it's absolutely essential for us to get a carbon market. Now, I would share some rather discouraging data, and this is slightly controversial. Uh, we are adding about 60 to 80 gigawatts of coal, new coal, in next few years. At the same time, we have climate targets of reducing our dependence on coal. We're adding more renewable capacity. I understand this is to meet the more electricity demand which is coming, and it can be debated that it's crucial to that kind of coal capacity. But the price of environmental damage has to be there, and that is not being priced in right now. So we need a mechanism where the environmental impact is being priced in, and investors have to put that as a cost when they're investing in such projects. And that is what a carbon market would do. As you know, I was talking about the international renewable energy certificate market. It's not very liquid, but it at least shows a way where any investor or any consumer who wants to create additionality and support such projects have a standardized mechanism to get to. But if that is not available, then it's very difficult to translate carbon mitigation into real money. And I think carbon markets will do a great job in doing that.
Great. Mr. Chintan, while we have discussed so many other instruments, ESG capital, green bonds, etc., but in the power sector, there is still a very heavy reliance on non-banking financial companies, NBFCs. How do we address this increasing reliance on NBFCs while all the other capital exists, but still, the likes of IRIDA, PFC are still one of the biggest lenders to the renewable energy capital?
One of the reasons that you require, they call it the systemically important NBFC. That's the word that RBI uses. And they are dedicated NBFCs for a particular sector. This sector may look very simple from outside, but when you actually start doing an appraisal of a project, it's quite complex. You can't expect mainstream lenders to essentially get into those technical appraisals. What was happening, even if you go to mainstream lenders, they will essentially look at your pedigree, then the project. But if you go to an NBFC, they look at the project first. Pedigree comes later, because they essentially do project financing. And that's the reason that the sector is growing, because we have some very dedicated NBFCs in the market. It used to be L&T Finance, Tata Cleantech, IRIDA is there, PFC, and now NAPFID also. These are needed because this is a very specialized sector. And just to add one more thing to my colleague over here is electricity cannot be stored. It has to be consumed when you produce it. The question is, solar may be the cheapest, but unfortunately solar does not produce in the evening or in the night. So there is a cost of transition. If you add battery to solar, the solar will be most expensive. So that's the reality.
Not on the latest tender. Solar is plus battery is still cheaper than coal.
So the thing is, you have to essentially primarily meet the energy needs of the India at all time slots. That's the key part to it. Now the moment you say the exchange market for solar hours is in the range of ₹2.50, not ₹5. ₹5 is in the non-solar hours. Unfortunately, if a thing will come in the future, you might have maybe lesser pricing on the solar hours because you don't have adequate demand over there. That's where NBFCs are needed to assess the project, because they understand the power sector market itself in reality, and you don't want to go wrong. The good part is, in the last few years, when the massive investments have happened, 80%, almost none of the project has been in NPA. The reason is the quality of the appraisal done by NBFCs is far superior. They have got this delta knowledge extra, which normally mainstream lenders may not have. But mainstream lenders are needed, very much needed, because they have much bigger balance sheet. So now it's more of a consortium financing. An average size is now 250 megawatt, 500 megawatt project. That component of a particular project size is about 2,000 crores, 2,200 crores. No single can do it. So it's a collective thing. But essentially, the appraisal is led by specialized NBFCs.
Okay, right. Switching gears again and talking about the international capital, Aalok, I mean, with COP approaching and with G20 Brazil also coming to an end, there have been some big commitments or announcements. Say, for example, at Brazil, they have proposed a global tax on the planet's billionaire that could raise $250 billion US, which can again fund climate change. And then also at COP29 presidency early in the year, they announced a new voluntary fund in which oil and gas extracting companies and countries will be asked to pay. Do you see these funds fructifying, and how much do you think emerging economies like India will be able to tap into this market?
I think it's too early, and especially from an India perspective, I don't really see these pools of capital turning up anytime soon. I think it'll take time. It'll be more of the traditional, pension sovereigns who are anyways active, and the large infrastructure funds who will be more active in the Indian market. But I think, as I was saying earlier, I think the strategics, especially Indian strategics who are raising capital from the equity markets, and the Asian strategics from Southeast Asia, Japan, are the ones who will continue to really fund, and be the consolidators in the Indian market. I think these things probably will play out over a longer period of time.
Right. We have some time available. We can take up few questions from the audience. I can see a hand raised. Can we get the mic? If you can introduce yourself and keep your question short, and if it is directed to a particular panelist, please let us know.
Aalok, the question is for you. Rothschild being one of the most, one of the best on the planet, how do you see the velocity and the direction of capital in 2030, India specific, especially in the credit and the family of funds of credit funds? Would you be able to look into a family of funds of credit funds for the power sector and or the hydrogen for that matter? My name is Syed Akbar Hashmi. I'm from Houston, Texas.
I'll just repeat the question so that I've got it correctly. Your question is, how do we see
my question
credit funds?
Yeah, my question is, the platform would be a credit fund, but what is the velocity, meaning how fast, and what would be the direction, pension plans, foundation, endowment funds, and of course, with people like you guys coming in as investment bankers, how do you see, of course, ESG being one of the most important element into bringing the capital for such a large need of hydrogen and or the RE? And what would be the amount of fund, 50, 10, 20 billion in 10 years? This is specific to Rothschild. Thank you.
Yeah. So look, I think the overall to reach the target of 500 gigawatts of non-fossil fuel-based capacity in India, our assessment is you need total of almost $200 billion of capital, mix of both equity and debt. And your question on pension funds, endowment funds. Look, all of the infrastructure funds who are investing or have invested in India since the beginning have all had these pension funds, sovereign wealth funds as their LPs. Because the funds who are actively investing, they are all GPs here, general partners, but the limited partners are all these funds from US, Europe, Middle East, etc. So they've already been invested for a long time. And we've had instances of sovereign funds directly investing as well, including in platforms, like the Chintan's platform, Renew, and some of the other platforms where sovereign funds have directly invested. So I think that capital has already been present in the country. They've had good returns when some of these GPs who've exited from platforms here, for example, when Ostro was sold and when Spring was sold, capital was returned back to these LPs. And they continue to fund. So larger infrastructure funds have in fact increased, as I was saying earlier, they've increased their allocation towards India. So I think that will continue. We are not seeing any kind of slowdown on that front. And specific to us, we are an advisory focused investment bank, and we've been around in India for now 25 years. And we've been involved in many of these situations, including advising some of these funds to invest in renewable projects in India. So to your question, I think this trend will continue. In fact, more of this will happen going forward as the country needs more capital to fund this kind of growth that we are targeting.
Are there more questions from the audience? Okay. Maybe just one last question from me and then we can bring this session to a close. We did discuss about power sector, but I just wanted within power sector, if one of you can throw, we are still struggling in terms of, getting more finance for decentralized renewable energy, especially solar rooftop. With the PM Suryodaya scheme, some of the risks have been addressed. Do you think there'll be more investment being available for decentralized renewable energies solutions? And also for MSME players, I mean, the risks are very, very different. How do we kind of come up or bring in more innovative financial instruments for the MSME segments? Anybody?
I can pick up the MSME part because the rooftop thing has been greatly addressed through SBI scheme. Now it's there, 7% rate of interest. Kusum also has been addressed to a great extent. We have already schemes by the nationalized banks. It's getting implemented. The challenge is MSME, and this is something that everybody is trying to battle around. And the only way out to go for energy transition for MSME is essentially straight away fund their books for them to set up the RE projects. That's the only way, because the group captive concept or a merchant concept will never fly with MSME because of the rating issue. Because MSMEs don't have proper rating, it's CRM rating. And they normally have a not so great balance sheet, which they make them bankable for projects will be created for them. So the only way out is they get straight away investment into either a solar park or a wind park for that pure captive utilization. And that's the framework that needs to be created, and a couple of NBFCs have started working on it. The good part is bulk of the state governments also has started offering interest subvention for such lending. And the biggest thing is that the CGTSME cover by the central government, which essentially underwrites 75% of the loan to a lender if the MSME defaults. I think you already have the instruments in place in India. The only thing is how fast we can execute it and implement it. So I think it more requires of putting all together on one particular platform, the services platform, because again, for an MSME to scout for land, permits, buying assets, getting it constructed is also going to be a challenge in small size projects. So you require essentially platform, maybe a fintech type of platform or services platform that can integrate all these things together and give it on a platter. That's what it would look like.
Great. With this, I'll bring this session to a close. Thank you to all the panelists for such an enriching discussion. Can we have a big round of applause for them?